Hello and welcome back to another accounting video in which we're going to look at acquisition of property, plant and equipment. Now we are switching gears and we are going to look at trading one asset for another asset. The assets that I'm trading may be similar in nature or may be dissimilar in nature. As in, for example, a company may trade an asset such as land for truck. Now, these are dissimilar assets. Now, FASB has changed the use of the words. They don't use the words similar assets, dissimilar assets. What they're concerned with is the ordinary, what they're concerned with is the uh, commercial substance of the transaction. So what they're looking at now is the commercial substance of the transaction. So as I mentioned, usually if the assets are dissimilar, there's going to be commercial substance in transaction based on the fact that my cash flows are going to be dissimilar when I have land versus when I have truck. Now, if I exchange one truck for another, will my cash flows be similar or dissimilar? It could go either way. It may or may not have commercial substance. So the real issue now FASB is looking at is, as a result of the exchange of the assets, will my future cash flows potentially change? This was done so that US GAAP could be consistent with the IFRS, and that's what we're going to work with now. So what does that do in terms of our journal entries and recognition of gains or losses when we dispose of the asset? Remember, when we're doing an exchange of asset, I'm giving up one asset. And traditionally, we've said that when you give up an asset, you take it off your books at book value and you recognize gains or losses. Let's see what we're going to do here. So if the transaction has commercial substance, I'm going to recognize any gains or losses immediately. If it lacks commercial substance, we have two parts over here. I did not receive any cash in the transaction. I may have paid cash, but I didn't receive any cash in the transaction. I'm going to defer any gains, but recognizes losses immediately. The third situation is the exchange lacks commercial substance, but I did receive cash. In that case, the gains, a partial amount will be recognized. Losses have to be recognized immediately. So in all three cases, if you have a loss, you have to recognize it immediately. It's only how you're going to deal with the gains. So if it has commercial substance, you recognize a gain. If it lacks commercial substance, no cash received, you defer all the gains that may be there. If it lacks commercial substance, but you did receive some cash, then a portion of that has to be recognized. So let's take a look at an example and see how we will work through with this. So we have a company, Holyfield Corporation, that wishes to exchange a machine used in its operations. Holyfield has received the following offers from other companies in the industry. So we have Dorset Company, Winston Company, and Liston Company. So it's going to pick one of these three choices it has, but I'm going to do the journal entry for each of these three scenarios if they actually did it. Okay, and there's also a fourth one, Greeley Corporation. So let's start with what we have here. For Holyfield, in their books, the asset they're giving up, the original cost is $160,000. The accumulated depreciation is $60,000. The fair value of the asset is $92,000, which means if they sold it in the market today, they would get $92,000. So let me do this calculation here on the side and show you what I'm looking at. I have $160 as the original cost. $60 is the accumulated depreciation, which means carrying value is $100,000 in my books. On this day, the fair value of the asset is $92,000, which means if I sold it in the market, I would sell it at $92,000. So what are we looking at over here? If I sold it in the market, I would suffer a loss. We already know what we need to do with that. Okay. So now the question is, what am I going to get in exchange? So if I went with Dorset Company has offered to exchange a similar machine plus $23,000. The exchange has commercial substance for both parties. Okay, so let me recap and see. It has commercial substance, which means any gains or losses have to be recognized immediately. So let me do the journal entry set up the journal entry. I will do it in the books of Holyfield and I'll do it in the books of Dorset. That's the two different parties who are doing the exchange. Okay. So for each one of them, what do we know? When you get rid of an asset, you're exchanging an asset in this case, I'm going to debit accumulated depreciation and credit the old machine. So for Holyfield, it's 160, 160 and 60. Okay. Now I'm going to do a similar calculation for Dorset. This is their asset. They have an asset. 120 is what's in the books, minus 45. That gives me a carrying value of 75. If they sold this, they would get 69,000. Okay, so do they have a gain or a loss? Well, it's a loss for them as well. They'd lose $6,000. Okay, so let me set up this journal entry for them. Accumulated depreciation debit. And this is for Dorset. So this is the easy part. We definitely know. I have an old asset, I'm getting rid of it. So we're looking at two different parties over here. Okay. The next question is, they're both getting a new machine. Well, it's new for them. For the other party, it was old. For them, it's new. Okay. And we need to find out what we need to value this at. That's the purpose of this exercise. Okay. Did this company get money or receive pay money? Okay, so one party received the cash, the other party paid the cash. So Dorset company offered to exchange a similar machine plus 23,000. So Dorset is the one giving the cash, 23,000, and Holyfield is a company that's, sorry, let me, they're getting the cash, the 23,000. Okay. Now, what else do we need to take care of over here? They have a loss in exchange. What's the amount of the loss? $8,000. Okay, we knew that $8,000. That's the number that we have over here. So what's the balancing figure? Okay, so I can say this is the balancing figure. So I'm going to put that down here. That's the balancing figure in the journal entry. What would that be? That's a 69,000. I'll come back and tell you what that number is. Okay. They also have a loss in exchange. Okay. The loss in exchange, how much is it? $6,000. I already knew that. So what's the balancing figure again over here for this company? Balancing figure for them is going to be the 92,000. So let's take a look at this again over here. The machine, 160 original cost. That's what they put over here. Accumulated depreciation, I'm basically taking the asset off their books and the associated account. Take a look at this number over here closely. Where do we see it over here? That's the fair value of this asset. Okay. I know what the fair value of the asset is that I'm getting. Same thing over here. Let's put this in a different color so we can see it. That's the fair value of the asset that they are getting. Okay. So you're going to bring the asset in as far as possible at the fair value of the asset that you're acquiring. Okay. In this case, it works out perfectly, and that's how they came up with that $23,000 cash payment. So it makes sense. They didn't just come up with that number. Okay. They know the fair value of the asset that they're getting. They know the fair value of the asset that they're giving up. And that's how they came up with that $23,000 in the exchange process. So that is if Holyfield goes with this first option. Now let's look at the second option. Winston Company offered to exchange a similar asset. The exchange lacks commercial substance for both parties. Okay, so it lacks commercial substance for both parties. So for both of them, it lacks commercial substance. They've offered to do an exchange. There's no cash over here, no cash received, no cash paid. Okay, so what do? If there are any gains, we defer it. If there's any loss, we're going to recognize it immediately. Okay, so now we're looking at the second company. So again, I'm going to set up my journal entry, set up my journal. We have the two parties over here, Holyfield and Winston. So let me start again with my notes on the side over here. Go through the same process, and it's going to be the same for Holyfield. We already know what it is. So it's really for Winston. What are their numbers? Okay, so we start out with the same thing. 152 minus 71. That's going to be their book value. So 152 minus 71 is 81 is their book value or their carrying value. That's what they have it in their books at. The fair value of their asset is 92. Okay, so 92 is a fair value, which means if they sold it in the market today, they would get $92,000. What's that work out to be? That works out to be a gain of $11,000. They can sell it for more than what they're carrying it in their books. Let's again recap over here. The transaction lacks commercial substance for both parties. There was no cash involved over here. They got to defer gains if there are any. Losses have to be recognized. This company has a loss, this company has a gain. So they have to recognize their loss, and Winston has to defer the gain. So again, let's see how we're going to set up our journal entry. Accumulated depreciation is going to be debit. The old machine is going to be credit. That part is fairly standard. We already know how to deal with that. We know the amounts. 160 is the asset, 60 is the accumulated depreciation. They're bringing in the new machine, and they have to recognize a loss in exchange. They know what the loss amount is. The loss amount is $8,000. So what will the balancing figure be over here? Again, let me specify and say that is the balancing figure in the journal entry. And that balancing figure in that journal entry that we have over here, again, that number that we have here, that's the same as what you have over here. We're bringing it in at this 92,000. Okay, now let's look at Winston Company, what they have. They have their old machine, they have their accumulated depreciation. Let's first start with that. Accumulated depreciation is 71,000. They have their old machine at 152. Those are those two numbers over here. They have a gain of 11,000. What did we decide that the gain what should happen to the gain? We need to defer it, which means we don't bring that into the journal entry. So that means this entire amount that we have here, that's going to be the balancing figure. All of it is going to be the new machine. And what does that number work out to? That works out to 81,000. So they're basically bringing it back at the carrying value. Whatever the carrying value was, that's what they're going to bring it back at. So it's going to be no change. It lacks commercial substance. Okay, so no change. They're not going to recognize any gain. The gain is gone. They have it at 81,000 over here. Now let's look at the third case. Liston. What's the deal with this one? They've offered to exchange a similar machine, but they want $3,000 in addition to Holyfield's machine. This exchange has commercial substance for both parties. If it has commercial substance, you recognize gains or losses immediately. So again, first let's start out by setting up the information here. We're doing this in the books of Holyfield, and we're doing this in the books of Winston. Okay, so this one stays the same as we've seen before. Those numbers are not going to change. Let's see what it is over here for them. Their machine, 160 and 75, fair value is 95. So what would that translate for them? So it translates to a gain of $10,000. Okay, they want cash. Cash is going to be, they want $3,000. So for Holyfield, what's going to be different over here as compared to the previous ones we've looked at? Okay, in the first one, they received cash. Here now they're saying that we are paying cash. Okay, so I'll start out with 60,000 debit for accumulated depreciation and 160 credit for the old machine. The new machine is going to be debited, but they're also paying cash, $3,000. Okay. They have a loss, and that loss amount is $8,000. That's not going away. We have that loss. So what's the value of the new machine? What am I going to value it at? 95,000. Again, this is the balancing figure. $95,000. Okay. They paid cash. No cash was received. Your defer gains recognize losses. They have a loss, so they need to recognize that loss. Okay. So that recognizing the loss stays in all situations. They have that. That's not going away for them. Now let's take a look at listing company. Accumulated depreciation debit, new machine debit. We'll see what that is. They received cash and they're going to credit old machine. Okay, so the accumulated depreciation is 75. The old machine is 160. They received cash of $3,000. They received the cash of $3,000 in this transaction. Okay, let's once again review. It has commercial substance for both parties. Okay, so what's the last thing we need to do? We need to recognize gains over here. You're going to recognize all the gain. How much is the gain? $10,000. Okay, so what's the new machine? The balancing figure. Balancing figure we have is 92,000. And again, this 92,000 is a fair value of this asset. Okay, it's the fair value of the asset that you're getting over here. So the only case in which you did not bring it in at fair value of the asset that from the other party is in this third case, where in the second case, I'm sorry, where the fair value was 92, but I brought it in at 81. That's because I have the gain of 11 and I didn't want to recognize the gain. That was the only reason why this is not the fair value of that asset. Okay. Now let's look at the last situation. Holyfield contacted Greeley Corporation, a dealer in machines, to obtain a new machine. Holyfield must pay $93,000 in addition to trading in its own old machine. The cost of the machine is $130,000. The fair value is $185,000. So if Greeley is a dealer, what does it mean? This is inventory for them. When they acquire do the exchange, they are acquiring the old asset of Holyfield. What are they going to do with it? They're going to try and sell it again. So that's going to come in as inventory for them. So let's take a look at this last set of journal entries, what this is going to look like. Again, let me start out by setting up for the two companies, their journal entries. And you will see for Greeley, it's relatively easy. Let's start out over here. This stays the same as before. Original cost 160, accumulated depreciation 60, leaving me with a carrying value of 100. Fair value is 92, which means I have a loss of 8,000. So now let's go through this. Accumulated depreciation is credit. Accumulated depreciation is debit. It has a credit balance. I will debit it. We know that amount is 60. Old machine will be credited 160. Okay. I have to pay cash. How much cash am I paying for a brand new machine with giving up the old machine? $93,000. I know I have a loss in this exchange. That loss is $8,000, never leaving me. It's there with me. Okay, so finally, what's the balancing figure in the journal entry? The balancing figure in the journal entry is 185,000. Where did you see that number before? That's the fair value of the new asset, the 185. That's how they came up with the 83,000. They knew what the value of my asset was, and they said the fair value is 92. They wanted another 93 in order to give the asset at 185. Give me the asset, not give me, they're selling the asset. Okay. So in the books of Greeley, what do we have? The cost of the asset is 130. The selling price is 185,000. So for this company, what are they getting? When they do the exchange, the trade-in, okay, when they acquire the asset, it's inventory for them. They will bring it in at the fair value. They know the fair value of the asset. They got cash of $93,000. This is going to be credited to sales. This is a sales transaction for them. They're a dealer, okay? They use perpetual inventory. So cost of goods sold debit, inventory credit. And that amount is 130. How do I know that? Well, that was given to me in the problem. It's 130, okay? So they came up with 83,000 because the fair value of my asset is 92. 92 plus 83, 185. That was their selling price. That's how they came up with that $93,000 and said that's what they want from me. Once again, what we are looking at over here is you need to find out if the transaction has commercial substance or it lacks commercial substance. If it has commercial substance, any gain or loss is recognized immediately. If it lacks commercial substance and no cash is received, you defer gains, losses recognized immediately. If the exchange lacks commercial substance but cash is received, a partial amount of that gain is recognized, not all of it. Losses recognized immediately. Once again, this is yet another example of acquisition of property, plant, and equipment. This is not uncommon at all when companies have assets and they exchange it for something, they trade it in for something else. So depending on what the situation is, a company has to decide how they're going to value the new asset. Giving up the old asset, that part is fairly easy. I know my original cost, I know the accumulated depreciation, I know what to take it, how to take it off my books. It's the new asset. What do I bring that in at? Did I pay any cash? If I paid cash, I received cash. Again, that's easy. That finally leaves me with how much I should value my new asset at. Okay. So again, losses in all cases recognized immediately. It's only that gain you need to see what we need to do with that. So with that, we conclude acquisition of assets. We next move on to subsequent expenditures. After you buy any plant asset, you're going to have more expenditures you're going to incur. So the question is it an expense or is it an expenditure that needs to be capitalized? Again, if it's capitalized, it's adding to the cost of the asset. That's the next example we're going to look at.